Welcome all. Thank you for joining us here. This is Andres Saias, CCO of RBI Private Lending. Thank you once again to join us on this new webinar that we're going to be explaining one of our main programs that we have here at RBI. So without further ado, let's get to it. Before we jump into understanding our fix and flip loan programs that we have here at RBI, I wanted to make sure that we understand first that what RBI is. For those of you who don't know us, RBI is a private lender. Now, private lenders have very different type of loans and metrics and ideas as to what do we like versus a bank, right? So the first thing that we need to understand is that private lenders try to serve investors that want to buy a property and they are in need of a quicker closing. So that means that we are more dynamic and flexible versus a bank, but that also comes into play with a higher premium in terms of their interest rates. However, most of the loans that we are used to lend on as private lenders is short-term products. So that means that the fee that the investor is paying is going to be for a short period of time. So the banks are usually more for like the conventional world for investors that want to do properties and keep them in the long term. So that's a little bit of a main difference factor between us as a private lender versus a bank. So now, why RBI Private Lending is one of the top lenders in the state of Florida. We're top three lenders in terms of volume in the state of Florida. And most of our loan programs are tailored for bridge, fix and flip, construction, and some rental loans. Why, for those of you who don't know why RBI Private Lending, well, we're a direct lender, which typically means that we use our own funds to lend for investors. Now we're not relying, we don't act as a broker, waiting for approval from the capital provider. And we're vertically integrated. This allows us to be, to act quicker, be more transparent, and give a personalized service that involves, again, quick, flexible, reliable, and complete closings. Now, as to one of the main products that we have, again, and the reason for those of you who are here is for the fix and flip loans. The fix and flip first are loans are aimed for investors that want to buy a property that is in some sort of distress, whether it needs some renovations or is suffering some type of things that can be improved by an investor and therefore collect a profit when they want to sell it. So the idea is that these investors buy properties that are performing below market value, make some renovations to them, and then sell or refinance for a long-term product so they can later on make a profit. Typically, these programs are tailored for investors, contractors, wholesalers, developers, and so on. Here at RBI, we have a lot of investors and we're accessible to everyone. We accept foreign nationals, we accept new investors, we accept experienced investors. All at the end of the day, we'll have different metrics and different terms on their loans, but at the end of the day, RBI is proud to serve most of the investors out there. Typically, on our purchase loans, we can do up to 85 LTC, which we're going to talk about what LTC means in a second, or 70% of the ARV. Sometimes we might go all the way to 90% on some certain exceptions. And on refinances, we can do 75 LTC, which is loan to cost, or 65 ARV. Our loan terms are between 6 to 18 months, meaning the terms of the loan, and there's no prepayment penalties for it. Typically, we lend to 1 to 4 units, townhouses, and condominiums. So for those of you who don't know what the terms of the fix and flips, which might differ from the conventional world, we have specific terms that goes for fix and flip loans and construction loans. Again, we're going to be talking about that in a second, but for those of you who have any questions about any specific loan scenario that you want us to take a look at, please go to our website and rbiprivatelending.com and just ask for us for to do an appointment, and we're going to be, of course, one of our sales team members are going to be providing you some assistance there. So going back to the terminology here, loan to cost, which is LTC, is the most typical in this type of loans, which it just means loan amount relative to the purchase price plus the rehab budget. So it's basically the loan that you're getting out of the total cost of the project. Another one is LTP, which is loan to purchase, which typically means the loan that you're getting relative to the purchase price at the moment of acquisition. Another one is the ARV, which is the after repair value. Since most of these properties have been performing under market, once they get some renovations to them, they have some appreciation and they improve the value of the asset. So we need to take a look at the after repair value when we're analyzing these type of loans. And the other main term that we typically see here is what it's called non-Dutch. Non-Dutch is just a type of interest in the way that we incur interest from our loans, from our payments. There's Dutch and non-Dutch. Non-Dutch means that you only pay interest based on the principal that you have in the moment in time during the loan, meaning when you get the first month, an initial loan amount of $100,000 and you have a holdback of $20,000, you're only paying interest of $100,000, not out of the amount that you're not being used for the renovation. So that's what means non-Dutch type of interest. In regards to how do we analyze clients and how do we give terms, we usually use three type of criteria and three variables that will be key to determine what type of terms we're going to give to the borrower. The first one is definitely the credit score or FICO score. We're going to see if they've been making payments on time on the products that they've been lending on. And the second one could be the experience that they have. This could be within the US, can be also outside of the US. Of course, if it's in the US, it will be easier to track. Not only that, but also it's going to be more likely that we're going to be able to count more of that experience. Finally, the third variable, the third most important variable is the size and location of these projects. This is because if we're doing a project that is total cost of $300,000 versus a project of $3.5 million, the terms might be a little different because the larger project could tend to be more riskier. So we have to take that into consideration. But overall, these three variables are going to help us identify what are the optimal terms for the specific borrower. Ideally, we're looking for investors that have 680 FICO score or more with a minimum FICO score of 620, two properties of experience, and a project size between $100,000 to $5 million. With that being said, that doesn't mean that we cannot do first-time investors. That doesn't mean that we cannot do foreign nationals. That does not mean that we cannot do larger or smaller projects. It's just that this is just to give you guys an idea of what is that we are looking for the most part. But at the end of the day, as I mentioned earlier, RBI is proud to serve and has competitive terms for everyone. If you have any questions about any specific type of scenario, again, whether it's the FICO score, whether it's the experience, whether it's the size, feel free to reach out one of our sales members, and we will be more than happy to just give you a quick quote to see what you guys think. As to the fix and flip program, there's two types of products here. So one of them is what we call the lender-funded rehab, and then the other one is the borrower-funded rehab. The first one is just the main difference between both of them is just that the lender-funded rehab finances not only the purchase but also assists in the funds when we're doing the renovations to the property. Whereas in the borrower-funded rehab, the investor is taking responsibility to finance on its own the rehab portion of the project. What does it mean for the liquidity purposes that we're looking for in those type of loans to approve them is that on a lender-funded rehab, we're looking for the down payment, the closing cost, and the 6 months of reserves. Whereas in the borrower-funded rehab, we're looking for the same three components plus the rehab budget. That is because the investor is claiming that he will take responsibility, so we must assume that they have those funds available to do the renovation. Here's just an example of lender-funded rehab. So let's just assume that we have this borrower that has a FICO score of 680, 2+ properties of experience, and he gets an approval for 85% loan to cost or 70% of the after repair value, which we typically choose the lesser of those two values. The purchase price in this example is going to be $200,000. The asset value is going to be $200,000. The rehab budget is $50,000, and the after repair value is, in this example, $450,000. Now, we must analyze and see if the investor is buying a property for $200,000, putting $50,000, 85% of that is $212,500, which is the lesser of those two. Typically, the lesser of the two would be the LTC, would be driven by the LTC. This is because that means that the investor has some skin there to make the profit. So in this example, if the full loan amount is $212,500, we're not going to give him that at the moment of acquisition, because that would mean that we're giving him more than 100% of the purchase price. So what we're going to do is we're going to hold back the rehab portion of it, and we're going to give him an initial draw of $162,500 with a $50,000 holdback. Now, as we mentioned earlier, the borrower will be only making payments, interest payments on the $162,500. So the holdback will be there, and as he advances in the project, he would be able to obtain those funds, and the principal would increase, and so on. The interest payments will increase, and it will be incurred on his behalf. Now, just to give you guys another example, but this one is a borrower funded. Let's assume that we have the same type of borrower, 680 FICO score, 2+ properties of experience, but we're going to approve him 80% loan to purchase or a 70% after repair value. Let's assume that we're using the same type of asset where they're buying the property for $200,000. The rehab budget is $50,000 and the ARV is $450,000. The loan amount in this example is going to be $160,000, and there's not going to be any holdback here because the borrower asked us for a borrower-funded rehab. So there's no holdback. We're giving him all the funds at once, and he will take care of the renovations to it. Yes, this is a smaller loan amount than the first example, but sometimes investors would like to see this type of product because they're going to go so fast in the project that they don't want to pay interest nor closing costs on some funds they probably won't even use. So even though this is a lesser attractive option in terms of loan amount, sometimes investors would like to obtain this type of proposal versus the lender funded. So therefore, we have to offer all our clients either option, and they're available. For those investors who would like to see the lender funded option, let's think about that holdback for a second. So that holdback of $50,000 in that example, how are we going to be able to give those funds to the investor? So that those funds will be given in draws. The way the draw works is that the investor needs to first put in the work, and then once that investor completes the work, he can contact our team and download an application, take pictures of the renovation that they have performed, and within a small number of days, 24, 48 hours, we will be able to review the pictures and later on release the funds. Typically, this period doesn't go more than 5 days from the moment that the investor asks for the funds till the moment that the investor gets those funds. Something important to mention here is that we only disburse on job to be to job completed. Not we don't disburse on job to be completed nor for deposits. So everything that the investor wants to get a draw on need to be completed on site at the moment that we do the inspection, or the in this case the investor takes the pictures. Some investors, although their type of strategy is to buy a property, renovate it heavily, and then sell it, that might be called a fix and flip, but sometimes we're not going to label that for our purposes as a fix and flip loan. Sometimes we're going to label that as a construction loan. So for RBI, what are the main differences between a fix and flip and a construction loan? Because there's a fine line that cross one loan product to the other. The first and most common variable that we see is to see and look out for any structural changes that the property might suffer. So if we're buying a property, let's go back to that example that we gave just earlier of $200,000, and the $50,000 that we put on rehab is going to be to extend the structure of the house, whether it's to add square footage, add another room maybe, and you're touching the structure of the house, that may be a reason for us to label that as a construction loan, because we're going to require for plans and permits, because in fix and flip loans we don't require them. So it's important for those of you who want to see this type of loan programs need to make this type of estimations. Again, if you have any specific questions, you can always reach out to us. The second main variable that we're going to see is if the budget from the property is 50% or greater relative to the assessed value of the property. So for example, if we have a property that is valued at $300,000 and the budget is $200,000, we can make an argument that that property is going to suffer heavy renovations that might affect the overall structure of the property. So that's another criteria that we use to label a fix and flip to a construction loan. But at the end of the day, the third one is the most important one, which is to take a deep dive into the budget and see what's the scope of work that we're having here. Why the investor wants to do a specific type of work to the property. And that might give us an answer as to we should label the scenario as a fix and flip or as a construction loan. I know that we haven't spoken about construction loans yet. That's a webinar that is coming up soon within the next couple of months. And I hope to see you guys around. These are just small general requirements that we have here for the fix and flip loans, which is typically IDs, credit application, latest bank statement, insurances, both builder's risk and general liability, the investor's track record, plans and permits, if it's applicable, purchase contract, rehab budget, the signed term sheet, and the general contractor's information in case the borrower does not have any experience. Here's just a quick overview of our programs that we have here at RBI. Again, we focus on the bridge loans, fix and flip loans, new constructions that we're going to be talking about in the next webinar, and our DSCR loans. That is our only loan program that we have that is for long term. The reason that we have this type of product is because we have investors that might buy a property, renovate it, and then later on keep it in the long term. So this is a nice way to send them off with a correct terms for a long-term product.